what about like KYC customers and like unique users that is on your platform
Yeah, I
today?
think we have about 20K that have signed up. It's right about 20K, 19K to be precise.
Got it. Yep.
Um, and about 5,000 cards issued.
Yeah, got it. And this is about $250,000 of spend per day across all of these customers.
Yeah, that's right.
Okay.
It's very peaky. So, for
Yeah.
example, yesterday was 230K spent.
Yeah. Yeah.
The peak that we've had was 310. So it's like
Mhm.
it's obviously very rapidly increasing, but if you average it out, it's probably right around 200K these days.
Okay, and we're live. Welcome to another episode of Bitcast. I'm your host, Jason Kam, aka at Maple Leaf Cap. Today is June 25th, 2025, 8 p.m. Hong Kong time. Bitcast is being live streamed to BidClub members. Questions are from the members and my own. This is not financial advice. Today, I'm speaking with Mike, the co-founder of EtherFi. Mike, welcome.
Hey, great to be here.
Yeah, nice background. I guess let's talk about the core EtherFi business first. From last I've checked, of the 2.6 million Ethereum, which is about 6.4 billion US dollars, staked and restaked with you. Why don't we start with this? Can you bridge me from that TVL to the actual fees to the EtherFi treasury / token holders? Maybe just kind of walk me through the math.
Sure. Yeah. So we have, maybe it's worth taking a step back and talking about the entire, I guess, business, because staking is just one aspect of what we do. It's actually not even our main source of revenue at
Mm.
this point. So what EtherFi is trying to create, our vision, I think we're actually pretty close to achieving, is what we call a DeFi bank. So it's a non-custodial banking alternative that allows users to do all the normal things they would do with their traditional bank, but in a crypto native way, in a DeFi product. So specifically, that includes the equivalent of a savings account, the equivalent of an investment or a way to deploy assets into DeFi, a spending, a credit card, a way to borrow against your assets, and so on and so forth. But the basic idea is, all the services that you've traditionally come to expect from your bank, but in a non-custodial way, and plugged into DeFi. So we have, broadly speaking, three products that accomplish this: EtherFi Stake, EtherFi Liquid, and then EtherFi Cash. Each of those products, I guess, respectively, they allow you to save, earn, and then spend your crypto. Each of those products has their own revenue. So we have quite a diversified business protocol at this point. So from staking, we just take a share of staking fees on the ETH that's staked, on the BTC that we have staked, and on USD assets. We actually have a stable coin as well that people can use. So we just take a share of staking revenue. In aggregate, the user pays 10% of staking fees to the protocol. On the liquid product, which is the earn product that deploys assets on the user's behalf into DeFi, it's depending on the specific vault. We've got about a dozen different vaults. The revenue comes from 1 to 200 basis points on the assets there. So it's almost 10 times more per dollar deposited than we make on staking. So that's why it's such it's a great product and provides a lot of value to users. And then finally, on the cash product, there's a bunch of different revenue streams. So in particular, because there's a credit card attached to it, we make about 100 basis points on the interchange. So every time the user swipes their card, the merchant pays about 3-ish% in fees. We get about 100 basis points on that. We also make money on borrows. So when a user decides to use borrow mode, where they borrow against their assets in the vault, we make a spread on the interest there. And then there's a couple of other layers of fees and sort of miscellaneous, but that's what kind of constitutes right now. The bulk is liquid and stake. That's the bulk of the revenue. Cash is ramping up fast. I think within 6 months, cash is probably going to be the main, cash meaning the card, the interchange, the borrow fees. That's going to be the main source of, or at least the largest source of revenue. Okay, does that make sense?
Got it.
Hopefully that's
It does. No,
not
it's
going
very
too far
clear.
into the weeds.
No, no, I think that's what I want, and I think that's what the listeners want. And just so I can break it down a bit further, um, the staking, like if people look at your headline, $6.4 billion of TVL, how much is that? How much of that is in staking versus the liquid? You think?
So there's a lot of overlap. I mean, this is the beauty of a vertically integrated product. Like this is vertical integration is a thing that's been around since like probably millennia actually, but certainly in the SaaS world, the industrial world, vertical integration is like a very standard playbook. What it means is, you sell widgets. Well, okay, what if the place that you source the raw materials for the widget? Okay, you bring that under your same business umbrella. Well, what if you own your own distribution and you just keep adding the full layers because you gain efficiencies that way. And you instead of paying your distributor a margin or your raw material supplier a margin, you can absorb that into profits in the business and transfer that to the customer in the form of lower prices. That's why McDonald's has lots of potato farms because they don't want to pay
Sure.
distributors and farmers, third party farmers. So it's the same thing, right? Again, this is a playbook that's been around for millennia. So weirdly, in DeFi, this has just not been a thing.
Yeah.
Instead, you have thousands of these very narrow point solution protocols that do one very specific thing and expect users to kind of wire up their own financial derivatives to use it. And this is why DeFi is, maybe a couple million people, daily actives. Because it's not designed for normal people. It's really only designed for power users. Okay, so going back to the question that you asked, there's a lot of overlap between the products. So pretty much everybody that uses Liquid is also a user of Stake. Everybody that uses the Cash product also uses Liquid and therefore Stake. So there's probably about 1 million ETH wrapped up in the Liquid product, 1 million staked ETH, because the Liquid products deploy and manage the stake products in DeFi, which of course is great for revenues and for just integration. So so it's not like like stake, liquid, and cash being separate. They're very closely intertwined. We actually have. On the stake product, we actually have the 3.1 million ETH staked.
Yeah.
And you could say, well, how is that possible? How
3.1.
can you have
Okay.
3.1
Yeah.
million each stake? Because the overall TVL of the project is only 2.7-ish or whatever.
Yeah.
Well, the reason is because the liquid vaults actually do some Aave looping. And so you have a couple 100,000 ETH of looped staked ETH, and obviously the debt on that is netted out. So the total amount of staked ETH is actually higher than the overall TVL. And the
I
subtle
see.
positive thing about that is that means, okay, we're actually generating revenue on 3.1 million staked ETH, not on 2.7, and we're generating revenue on whatever it is, about 1 billion in liquid deposits, then versus just what's under the hood. So
Got it.
it's anyway. So it's all very
Got
closely intertwined. That's the short answer.
Got it. That's very helpful. And so let me break it down. So on the liquid side, it's 1 million ETH staked, and then if I apply 1 to 2%, 100 to 200 basis points on that, that's about $35 million annualized. Just about. Does that sound right
It's
to you?
not quite that high. There's,
Yeah.
some vaults have higher fees, some vaults have lower fees. We talk pretty openly about our revenue. We have this big, post that we publish that talks about the breakdown. I think it's about. It changes obviously based on like
Yeah.
the price of ETH and a lot of parameters. I think it's about 25 million in revenue for stake specifically.
That sounds about right.
Um, I think maybe another 20-ish million revenue on liquid.
Yeah. Yeah.
And then currently cash is probably annualizing a couple million in revenue, but ramping
Yeah.
up, super fast. It's like doubling every couple weeks.
Got it. That's helpful. I want to talk about the cash business in a second because I think that's going to take up the bulk of the interview. Just on the liquid and the stake side, I guess the only thing I have to ask is you have such dominant market share there. Like, if you can remind us what's your market share versus the overall market, do you expect that business to grow meaningfully, whether it's through tick rate or through other lines of business in that liquid and stake side, if we don't count the card?
This, yeah, well, but again, it's all integrated, right? Part of the cash offering, if you look at it in isolation, is a corporate card offer. So we have the ability for businesses. We have about, I think, 100 now onboarded that are using the EtherFi Cash product for both treasury management because they hold a bunch of assets in there and deploy it into liquid, for example, and they use cards to to manage their spending. Um, and so as we onboard more businesses, that will lead to more deposits into liquid and stake. Again, vertical integration. And so that'll, I think, over time, that'll significantly grow there's a virtuous cycle there. In addition, I mean, I think I can talk about this at a high level. I mean, we're talking to all of the, ETH treasury companies that are out there and starting to have conversations with Bitcoin treasury companies to obviously get them to deploy their assets into EtherFi. I think that's billions of dollars of additional stake that's available. Anyway, there's for sure. The short answer is yes. I think the amount of ETH staked, I guess if you look at that in isolation, is going to continue to grow.
Mm.
We're I think we're currently Aave is like 8 million, maybe a little over 8 million ETH, and we're
Hmm.
about 3 million, maybe eight
Yeah.
and a half. So
Yeah.
I mean we're a very solid kind of number two in the
Yeah.
staked ETH
Yeah.
category, and we're growing. I mean we're continuing to grow. Lido, did I say Aave or did I say Lido?
Is that
Lido is about
yeah.
yeah, sorry. Lido is about 8.5 million ETH. We're like I said, about three. We're
Yeah.
continuing to grow. I don't look at that frankly as very strategic, as like we have to have the most staked ETH. I think the strategic value is in the fact that we have this vertically integrated product where we generate, $1,000 to $2,000 a year per user.
Mm.
Um, that's what actually matters. I mean, you don't actually make any, like staking is the lowest margin product out of the ones that we offer. It's really, frankly, doesn't make any sense as a standalone business.
Yeah. And just so I have there's no really cost associated with the stake and the liquid business.
Um, well, it depends what you mean. If you're talking about
Yeah.
like COGS, cost of goods sold,
Yeah, like compared to the sort of
there's
60,
some for
50,
sure.
60.
Well,
Yeah.
like for example, we take 10%, 5% goes to node operators. Can we
Yeah.
improve that margin a little bit? Sure, but
Hmm.
so that's COGS. On the liquid, we have Veda, which is the contract deployer, so they get a share of the vault fees
Is that
on
10%? Is that
cash.
50%? Yeah.
25%.
Got
Fine,
it.
whatever.
Okay.
I don't even know if I'm supposed to say that, but
Yeah. Yeah.
25%.
Okay, we cut
And
that
then
out.
the on the cash product, I mean, there's
Yeah, there's a whole
quite
slate.
a number
I
of
want to spend most of
players.
the time on the cash, but I think I just want to
Yeah,
cover this side of it first. So your target. I mean, I'm not going to say your target is Lido because it seems like you're pretty content growing the
it's
stake plus
not.
liquid.
No, in
Yeah,
fact, we're the largest holder of STETH.
yeah,
Like
yes,
literally, like
yes,
because we allow STETH
yeah,
deposits.
yeah,
We're the largest one. So
yeah,
Lido's great. May sound strange, but yeah, we're collaborative. I don't view Lido as
yeah.
like a target.
When you think about what grows the pie for this kind of 3.1 million ETH that you have, that is like generating $50 million for you a year or maybe more, do you think of the card business being the largest driver, or do you feel like there's sort of still organic growth from all these, Bitcoin and ETF treasuries that are out there, ETH treasuries that are out there
On staking specifically,
on staking and on
um,
liquid?
yeah, it's combination. There's multiple drivers here. Each product, here's a way to think about it. Each product has its own user acquisition mechanism. So and we have people that are responsible for customer acquisition on each product line. And each product line helps all the other product lines. That's I keep like talking about vertical
Yes.
integration.
Yes.
This is the magic, is like it's a virtuous cycle, because as if a user uses you for multiple products, they're also much less likely to churn,
Yes.
right? And your cost of acquisition is lower, because cross-selling a user into another product is much lower than acquiring a net
Yes.
new user. And you get much
Yes.
stronger network effects because people are just aware of you more, because you have multiple lines. So it's a feedback loop. Every product helps every other product. Actually, that's why this model works super well. If you're talking about specifically staking, what we're doing is obviously like we do all the on-chain analysis, find the largest ETH holders, wallets, trying to identify who they are, reach out to them directly. It's mostly a whale-driven games. So there, it's the treasury companies, it's individual whales, it's whoever. It's liquid funds that have ETH on the books, and so there's an ongoing outbound outreach program. 15 conversations a week. Driving deposits, and that drives 10-20K a week in deposits, more usually, more or less depending on the
Mm.
week. So that's specifically on the stake side. On the liquid side, that currently is driven mostly by campaigns and cash users. That's been the biggest driver of growth there,
Mm.
because cash users deposit into liquid, because that's the most efficient way for them to hold their assets. And then
Yeah.
on the cash side, it's been almost entirely word of mouth so far, plus like a
Mm.
few campaigns that we've run.
Yeah.
But it's going to start. We're going to start ramping up programmatic marketing on that to really drive customer acquisition there.
Good. Okay. Before we move on to cash, that's the bulk of what I want to. I think people have this perception that you're just a, ETH staking and restaking company, which is, I think it's like underpricing you, because there's this new business that's growing, and every time
Yeah.
it grows, it drives the whole business. But just so last question on this stake and liquid side, and we'll move on. What would be like a good target for you to grow this business at continuously going forward? Is it like 5% a year, 10% a year? Like, what would that kind of look like for you?
No, I mean, this year we're trying to get to around, I think our internal target is 3.7 million ETH, which
Yep.
is very conservative, because
By year end of this year.
yeah,
Yep.
it's like the reason we don't set like a more aggressive, because if we said we need to grow it to 5 million ETH, 10 million ETH,
Yeah.
and we put all our energy in that, we could easily do that. Like there's a ton of things we could be doing to drive that adoption. It's just not the most strategic thing. I mean, it's a very low margin business. In and of itself, it doesn't matter that much. We think organically and just through the normal course of business, it'll probably end up around 3.7 million ETH. That's our internal target.
That's a steady. Okay. And then with the ratio of stake versus liquid be the same, kind of a 3-to-1?
No, we're trying to grow liquid a lot more, because we make 10 times more. The protocol generates 10 times more revenue on liquid than stake. Every ETH is worth 10 times more.
Yeah. So liquid would be like 1.5. Yeah, go ahead.
Yeah, like 500K ETH, I think, is what we're trying to get to.
Okay.
Net,
1.5.
like.
Oh, okay.
500K ETH. So that's whatever. 1.2 billion or so.
Yeah.
Yeah. Sorry. Okay. To be clear, there's this is nuance in terms of how we measure it internally. There are some vaults. Most of the vaults we monetize, the larger ones. Some vaults they're more of a promotional thing, and we actually don't monetize them. Like, for example, the Bear Chain vaults. At least the initial set of deposits, that didn't generate any revenue. Now they've been sort of flipped to where they do generate revenue. But so when I say 500K ETH, I mean in the pool of vaults that is monetized.
Sorry, but previously you said liquid is like a million ETH. How do I?
Sorry, that's including all the loops, not the net amount.
The net is how much?
I think just over 300.
Okay, so like
ETH, 300K ETH.
Okay, yeah. I see. So it's
that
like
sounds right.
So it's like 1.5 million ETH. Okay. If it's looped.
Correct. Yeah. I don't. Sorry. The looped amount I don't know exactly, because we don't really like. That's more just a strategy within the vaults. So I don't
I
know
get it.
that precisely off the top of my head. I'm fairly
Yeah.
confident of the 300K ETH number because that's
Yeah.
something we actually do care about quite a bit.
Okay. Okay. So this business, instead of 50 million today, assuming ETH price doesn't change, it should be like 80 million, something like that by year end. 70, 80 million.
Um, Stake and liquid?
Yeah.
Yeah, that sounds right.
Okay.
Give or take, yeah.
Great. Um, that's very helpful. Uh,
Run rate, to be clear. Like
run
obviously it
run
ramps
rate.
up through the years, so 80
Yeah.
million
Yeah.
run rate. Yeah.
Yeah, very clear. Okay, good. The data I just got from you, I think on the cash or card side, it's 100 logos, business logos that are onboarded in a almost ramp fashion. So they
Yeah.
stake with you, they earn yield for you, they spend with you. On Dune dashboard, I also see maybe like a
Yeah. So we have
250K. Yeah, go ahead.
I can tell you, I'm looking at our dashboard right now. So we have
Mm,
about 400 businesses that have like started the process that have not completed it. 81 that have passed KYB,
mm-hmm.
and then 63 that are now spending.
Yeah,
So that's like the funnel, the full funnel of businesses. And like it
got it.
takes KYB. If for those of you that haven't gone through the process, if you think KYC is painful, KYB is like
Terrible.
in order of magnitude, because you have
Yeah,
to get all the formation documents. Every UBO, ultimate beneficiary of the business has to KYC. It's like a whole process. So it takes sometimes weeks or even months to KYB. Uh,
yeah. And then that's businesses. What about like KYC customers and like unique users that is on your platform
yeah, I
today?
think we have about 20K that have signed up.
Yeah,
Uh, yeah, it's right about 20K, 19K to be precise.
got it. Yep.
Um, and how many cards? About 5,000 cards issued.
Yeah, got it. And this is about $250,000 of spend per day across all of these customers.
Um, yeah, that's right.
Okay.
It's very peaky. So, for
Yeah,
example, yesterday was 230K
yeah,
spent.
yeah.
The peak that we've had was 310. So it's like
Hmm.
it's obviously very rapidly increasing, but if you average it out, it's probably right around 200K these days,
Yeah. Okay, great. And then
which is
so
pretty
so
solid.
yeah, and then running on your math because there are some other metrics, right? Which is like almost $47 million is kind of like sitting there with you because you have these customer base. There's
Yeah.
$1.4 million that are being borrowed against sort of their staking or their liquid restaking. Um, of all of this, I'm just trying to jive with the numbers you just gave me. It's a 1% interchange fee that you charge.
Yeah.
There's a spread that you charge on lending. I mean, it's not that much because if it's 250K spent a year, a day, it's like $100 million run rate. That's like $1 million of interchange fee. And then you have some lending net
That sounds
profit.
about right. Yeah, that's
Yeah.
right. So it's right now it's not a huge. It's only. I mean, this is like a month and a half old. So from zero
Mm.
to let's call it about a million run rate in a month. Like that's not bad. That's pretty
That's
good.
not bad. That's good. I wish I could make
Yeah.
a million in 1.5 months.
And yeah, and it's ramping up pretty fast. We think.
Yeah.
I mean, if you take into account the 47 million, let's say we make blended right about 100 basis points on that. That alone is 430K.
Yeah.
That's only
Yeah.
there because of the cash business. So like
Yeah.
if you kind of look at it, it's actually more like 1.5 million,
Yeah.
in aggregate. And like I
That
said,
makes sense.
growing pretty fast. We think it'll,
And
really like these types of businesses, the way to model them is less about like, it's not like Coca-Cola where it's like, all right, it's going to grow, 6% a year. And this is like, it's more, it's compounding growth. It's exponential. So, it's the way to frame it is like, okay, how many times does it need to double before, this thing gets really big? At around like 10 million a day in volume, like this is a very serious business. Now you're making like in aggregate across like all the different components, you could be making like 150K, 200K a day on that. And like, how many times do we need to double before we get to 10 million daily volume? Like, it's not that many. Like, we're
yeah.
actually not that far that far
Yeah.
off.
like five to six times. Uh,
Yeah,
Before, because I really want to ask you about this, but before we get there, so you do pay a 2 to 3% cashback on the spend, correct?
correct. Yeah.
Okay, so this business on a net basis currently run rate is unprofitable if we don't count the labor.
Uh, no, because
Hmm.
we pay the cashback comes from our partner Scroll.
Squirrel. Okay.
So we
Okay.
partnered with we were going to initially do our own layer two,
Hmm.
um, but pretty quickly realized we even launched it. We launched the layer two,
Yeah.
but we pretty quickly had this realization that like it actually makes way more sense to partner with an ecosystem rather
Mm.
than just trying to bootstrap another our own layer two. And so we partnered with Scroll, and so the cashback is funded by Scroll, and that you know it's actually very mutually beneficial. Right
Yeah.
now, we're about something like 60% of the TVL on Scroll comes from EtherFi Cash, and so like
Hmm.
it's a phenomenal like driver of activity for Scroll. I think
Yeah.
I don't know the exact numbers, but I think we're something like 20% of transaction volume on
Mm.
Scroll,
Hmm.
of like actual daily transactions, because it's probably like I don't know, yeah, 5,000 transactions a day or so.
Yeah.
Um, so it's very mutually beneficial. I mean, this is like
Yeah.
bringing a lot of like activity on chain,
Yeah.
like swaps, DeFi deposits, etc. And in
Yeah.
exchange, they pay what is like actually a pretty efficient customer acquisition cost.
Yeah.
So anyway, so that's why it's not unprofitable. It's like that's
Ah, I see. Somebody else pay for
yeah.
it. I mean, I guess by golly, if you hit $10 million of daily transactional volume, they're going to be paying through the wazoo for that 2 to 3%. So I'm guessing it's going to get discontinued at some point.
I mean, it's not. Uh, we're going to make sure that we remain competitive as far as the cashback
Okay.
goes. So yeah, I guess I mean you're right. At some scale, I don't know if it's possible to sustain that. Just with the partnership from Scroll, but I think there's other ways that we can.
I
Uh,
guess, I guess at some point, like Base or Solana pays for it. And you just like,
um,
fuck you and move on to some other
no,
chain that
no,
wants your.
we're
Okay.
we're we view the Scroll partnership as long
Okay.
term. We're not
Okay.
looking to be mercenary and move off of that. I'm just
Got it.
saying, like, maybe we supplement some of that with ETHFi tokens, and as
Mm.
we integrate more of the stack of the card program, we can actually capture more margin there. So instead of 100 basis points, that turns into 200 basis points.
Mm.
And then we start incorporating, for example, swaps in the app, and perps and
Yes.
other revenue drivers, and then that's the way to make the higher cashback sustainable.
Got it. Standing from 250K, 300K a day today, which is a mix of corporate plus like retail kind of, um,
Mhm.
going from that to like 10 million a day, um, how long do you think it takes you? How much do you think it costs? And then would the mix then be considerably different versus today?
It's very hard to predict because things are just changing so fast.
Yep.
Um, yeah, it's very hard to predict. Right
Mm.
now, the vast majority of that is retail. We do have a good amount of corporate spend, but the thing about corporate spend is that it's much more uh, like
Chunky, I guess.
lumpy, yeah, lumpy and chunky, whatever. So one large corporate customer can dramatically shift the equation. For example, we're onboarding a bunch of node operators onto the card program, and then they have millions of dollars a year of infrastructure spend that's going to be going through the system, and so that's an example where um, that could really like shift the equation. And also, corporate customers get less cash back because, frankly, they just don't need that incentive. It's more of an operational thing for them, and so that reduces the kind of aggregate amount of cash back that is paid out. So, I think if we can get to 10 million a day by like mid next year, that'll
Wow.
be a pretty pretty good win. Like internally, I think that's what we're targeting.
Got it. How do you plan to get there? Because right now it's word of mouth.
Yeah, so our budget roughly is $4 million for customer acquisition for the rest of this year. We haven't started that yet. We're waiting
So how much?
to
Sorry, how much? 40 million?
$4
Okay.
million
Yeah.
in
Yeah.
customer acquisition.
Mm.
Our current cost of acquisition is about $50 to $100 per user or per cardholder, per active
Mm-hmm.
cardholder.
Yeah.
So that would be 40 to $80,000, 40 to 80,000 users.
Mm-hmm.
Our internal target is to get to about 100,000 users by the end of this year. So I think
Yeah.
that's quite doable. I mean, we're just at the pace that we're growing. I think that's already quite doable.
Yeah.
Um,
And
you
sorry,
know,
sorry to cut you off.
the
When you say 100K users, that's 100K cardholders.
active users, active
Active,
cardholders. Yeah,
active cardholders. Okay.
yeah,
Which is 5,000 today.
that's right. Yeah,
Okay, so 20x. So the spend should go from 250K to 5 million, right? Basically, if you hit your target.
yeah.
Okay,
I mean,
got it.
I'm sure it's like whale heavy
Yeah,
now because
yeah,
that's probably the early adopters.
yeah.
So, I mean, this is why it's hard to predict. On the one hand, we're
Mm-hmm.
going to have more corporate customers, which will skew it higher. On the other hand, we're going to be getting more kind of normal retail users, which is going to skew
Yeah,
it lower. So, is it like 5 million a day? Is it like 2 million a day? It's very hard to predict at this stage. In a couple months, I
yeah,
think we'll have a much more refined model. But like a month and a half in, it's it, I have pretty high confidence in getting to that 100K number.
yeah,
Um, the specifics around exactly like what transaction volume and revenue that drives is a little harder to predict.
yeah. I guess the LTV now is very hard to calculate because it's 1.5 months old.
Yeah,
Um,
that's right.
but if you can kind of run rate that spend, I don't think you can. But like the efficacy for marketing today must be really high. Like,
Yeah, for
yeah,
sure. Yeah. Like I said, right now we generate roughly $1,000 a user. So the ARPU is about $1,000, and
yeah,
so that means our
yeah,
payback is a month and a half,
yeah, yeah.
which is great. That means you can like that's a very rapid
That's
cycle. You
ridiculous.
acquire a
That's
user
ridiculous.
and then you
Yeah.
almost immediately, yeah. I mean, that's not, I don't know how different that is, for example, from let's say crypto exchanges. They're,
Yeah.
this is why they're such ridiculously profitable,
To be very
businesses.
fair, the crypto exchanges, the users actually has to turn off longer term. Like they actually just die.
Yeah, that's right.
Versus, I
They have
guess.
to because eventually they run out of money. Yeah.
Yeah. Fair enough. That's interesting. I guess the LTV to CAC has to go down over time as you scale to the masses. Um, you probably have done this math, and if you haven't, that's fine too. Like if you hit your target of like 100K, like card owners, um, like what would be considered like where does that rank you versus the overall card business globally? Like is it like Capital
Oh,
One? I
it's
don't think it. Yeah,
as
yeah,
far as no.
yeah,
They have it's like Amex has I think about 100 million cardholders. I
yeah.
think maybe
Okay.
I'm probably off by 20 or 30%.
Yeah,
So I mean
yeah, tiny.
but they're a $200 plus billion enterprise. Crypto.com has I think about 10 million cardholders.
Mm-hmm.
But they generate very little revenue per user. They tend to be like much more down market. It's very hard to triangulate exact numbers, but I think crypto.com does $5 to $10 million a day in volume. But they're also much more extractive. They have way more fees, FX fees, on-ramp fees, off-ramp fees, etc. And so they probably drive a fair bit of revenue on
Yeah.
those users.
So I guess for crypto.com, that line of business should be doing about like 20 to $30 million a year in revenue.
It's so hard to know. Yeah, I mean, I don't
Okay.
know. They don't publish
Okay.
this stuff.
Okay.
Yeah, everything is like kind of speculation and triangulation.
I see. What's the hardest part you think? Like, are you very confident in sort of getting to that sort of 10 million a day target, or do you feel like there are some roadblocks that you guys are still figuring out to get there?
Yeah, no, there's a ton of roadblocks.
Yeah.
You know, so far we've seen pretty strong product market fit. Just
Mm.
the fact that if you look at our cohort graph, it's like perfect. Like there's basically no user churn. I mean, we acquire a customer and they stick around. That is very strongly positive. We see a huge amount of referral activity. I don't know if I have the dashboard right off. Yeah, I don't have it right on me right
Mm.
now. But you know, like give or take about 30% of the users have been referral. Like it's not that like people there's word of mouth as well, right? Without the actual referral link,
Yeah.
but a huge number of users are coming through referral links, which means it's people are like posting the link and getting traction. Some like some of the highest referrers have referred hundreds of customers. So that's a very positive thing. Those are very, very strong early signs.
Mm.
I'm so yeah, I feel pretty good about it. I think 100K users, which in turn is let's say a couple million a day in transaction volume, feels very, very doable. I'd be
Mm.
very surprised if we're if we're
Afraid you're
not
not
there
gonna.
pretty soon. Yeah.
I guess at that point you'll be paying out like, I don't know, like 30, $40 million a year in like cashbacks. Um, Scroll today is 200 million for those who don't know. So there's almost no way they can pay it. So you're gonna inflate EtherFi token, I'm guessing, which is like a 2-3% annual inflation to fund this, you think?
Um, so first of all, there's a lot of work that we're doing to integrate the stack, I guess, on the card program, which will give us more margin to work with. Like, for example, Capital One pays out, I think, just over 2% in cashback. And the reason they can do that is because they have the full stack integrated. And so that's something that we're planning to do.
Mm.
Other revenue drivers, as I said, swaps, perps, borrowing, etc., increase the margin as well. And so that will allow us to pay out more. So you're right. I mean, we obviously
Mm.
at scale when when we're talking about hundreds of thousands of dollars a month in cashback. That's
Yeah.
not. We don't expect Scroll to
Yeah.
continue to be able to pay in that. That's more of a bootstrapping mechanism.
Yeah. I guess a better question would be like, because
But I mean, I
like,
think the Scroll token probably will be impacted positively from all this
oh,
activity.
I see.
You
Once
know,
it really goes up, 'cause, I mean, they
but
make that
that's. I
money.
mean, you're right. It's not. I don't think that's a long
Yeah.
term thing.
I guess a better question here would be, 'cause it's like 1% interchange, but you capture these customers in other ways that would be in lending and swaps and staking, like all these areas. You
Hmm.
probably have to pay that cash back for a very long time. It's a negative net margin business today, but you're not paying that cost, but over time you will be, probably through token inflation or out of your own pocket. Like over time, like what is the net margin for this cash business for you, you think? Then like once you,
Well, if you
yeah.
look at, for example, Revolut or Chime or other neobanks, almost all of their revenue comes from interchange. I think what happens over time is the amount of cashback comes down. For example, right now our lower tier, is 2% cashback, and so that um, you know that's a significant reduction in costs. And we think eventually that's probably the bulk of the customers are going to be on that tier.
Mhm.
And once the full stack is integrated, like 2% is actually doable and sustainable with like pretty good margins, across the various revenue drivers for each user.
Got it.
So I don't
I
I don't
get.
think we're never going to have this be a negative margin business. Like
Hmm.
that's just not going to happen.
Yeah. Um, I guess another way to put this is that because I think the most fair way to categorize your business actually would be the stake and liquid as one, right? And that's 50 million. And I would almost feel like your cash business should be viewed at revenue wise on a net basis. in the sense that that's really kind of what you take home, because the other part is pure profits almost. Um, in that case, because you're saying
Well, but
maybe
they
like
support each other. I mean, I wouldn't, like I said, I wouldn't view them
oh, for sure.
like our primary driver of liquid growth is
That is
cash.
true. That
So
is
if we
true.
acquire a cash user, they
Mm,
generate revenue, on the liquid part, and borrows and swaps and etc. So it's not, if that's where, like, it's not that you can like fully split them out.
that's for sure.
And it's, for example, and again, I don't think we'll ever be in this business, but even if like the card business specifically, just like standalone, the cards in itself is the loss leader, as for example, like Robinhood has a 3% cashback thing.
Yes.
Um, Coinbase announced their card. There's a lot of gotchas there, but they're claiming 4%
Yeah.
Bitcoin cashback. It's whatever. Let's put that aside. So it's like, okay, let's say that specific thing is a loss leader. Well, but like Robinhood obviously makes a lot of money on the users, where like the card makes it worthwhile. So similarly, like you can't just look at it as like, okay, well, this cash business is a loss leader, therefore it's negative margin. Because if you're making a ton of money on the other products, then it's profitable.
Got it. So you
But
would
again,
almost
to
expect
reiterate,
the, yeah.
we're not. I don't think we're ever going to be at a point where the card business is a loss leader for us.
Got it. Okay. And you expect the mix to be continuously retail, but both revenue and spender.
Um, I don't know. I mean, we're going to drive both as hard as we can.
Got it.
It's hard to predict whether corporate or retail is going to be dominant.
Mm, I see.
I suppose by sheer volume, there's more retail users, whereas like the number of crypto businesses that have like large crypto treasuries there's about 6,000 of them. Um, so maybe that tops out over time. Maybe we top out at 1,000 crypto businesses. That would be pretty good market share. Um, and so I suppose at least in the near term, retail is going to continue to dominate.
Mm. If you hit your target by mid next year, I suppose this whole thing. Now I have to look at this whole thing holistically. You'll be at 100 million plus kind of run rate. Is that fair to say?
Yeah, for sure. I mean, our internal target is getting to about a 80 million run rate by the end of this year.
Got it.
Obviously, so much of that depends on the price of ETH. I think that's assuming the price of ETH being around like 2,200 or something.
Yeah.
So, like, there's a very big variance in that. Yeah, I can like break this out more.
Yeah, no, I think I roughly got what that mix comes from, because if you hit your target, it'll be like 70 million ish from the liquid and stake, and then maybe 5 to 10 million from the card, because you can ramp that up pretty quickly if you spend your 4 million effectively. And
Yeah, like the cash business will be at about a 12 to $15 million run rate by the end of this year. This is what we're assuming. Um, and the profit on that is probably a couple million net of all the cost of goods sold.
yeah,
Yeah.
yeah,
I mean, this is very, very high variance.
yeah, of course.
That could
We're
be
not
50%
even.
lower, or it could be 300% higher. Like there's a lot of variance. Probably more to
Yes.
the upside, but a lot of variance on that.
Um, how much time would you say you spend on the liquid and stake side versus the cash side today?
Uh,
Like a
well,
percentage.
it's different people. Different people are
Mm,
working on it. Like we have our ecosystem team, and they're primarily focused on liquid and cash. Liquid and stake. Continuing to add integrations and partnerships. I mean, we just launched this Katana Vault
mm,
that maxed out pretty quickly, and that's an example. Um, and then there's another team that focuses on cash, that's specifically focusing on growth on that side. So it's different. It's different people, different teams that are working on it.
got it. But for you, your mind space, like every day you wake up,
Oh,
like
I mean, I'm focused on all of it, but
Okay, got it.
yeah, I don't know the percentage. Probably
Yeah.
more of it is biased towards cash right now because that's like
Yeah.
the shiny new thing, and has the highest upside,
Mm,
and has this sort of virtuous cycle where, I mean, like most of our liquid deposits are coming from cash users. So like that means like drive cash really aggressively because that's going to help the rest of the business. So that's, I would say probably most of it is spent on liquid. But for example, we have cans coming up next week, and a lot of my time is spent with liquid funds trying to get ETH deposit and treasury companies and so
yeah,
on. So it's a mix.
got it. Let's say by midpoint next year you hit your target, right? You got the 3.7 billion that you want, 3.7 million ETH that you wanted. You
Mhm.
get to 5 to 10 million of transactional volume, like it's really humming. You become a real force in the crypto credit card industry. You're like beating Fold,
Mhm.
you're beating Coinbase, but it doesn't matter. Like, and then the whole business is humming as a whole. Like the crypto ramp that you're building is kind of working. Everybody knows you. People are
Mhm.
really using your product. What's kind of next? Like, do, do you keep doing the same thing and get to a bigger AR number? Do you think there's like an end goal you try to get to once you hit that?
The North Star is a crypto native neobank. So
Mm,
you can think about the list of features and functionality that one would need around that, and like that's basically our roadmap. So what's some of the stuff that we want to add? We want to add much more holistic portfolio tracking and management in the app, which is going to be a big project. So it's just easier for you to keep all your assets there because it's a really nice way to track it. We obviously want to integrate like as many payment rails as we can, so you can like send money with with Zelle or Cash App or
mm,
whatever, PayPal, like just really nice, easy way to integrate that, and Pix in Latin America, and integrate Plaid so you can on and off ramp really easily. At some
mm,
point there's going to be like issuing actual credit to users. So in other words, not just the current model of like fully over collateralized. We there's a lot of high net worth individuals there, and we want to be able to actually issue them credit with partners. At some point there's going to be payroll integration, especially for crypto employees, like where we just want to make it super easy to have your payroll go directly into EtherFi. Accounting and tax integration, so that
mm,
you can like click one button and like all your crypto taxes are done for you. You can go on and on. Tokenized real world assets. We want to make it possible for someone to allocate to the S&P 500 within their
yep.
portfolio and then borrow against that in the same way that you can currently borrow against ETH and BTC. It's just that there's like this never-ending list. We want this to feel like just a really nice polished fintech product where under the hood and the way it operates is fully non-custodial and and integrated into DeFi. That's how I think we get to onboard the normies, is make it just as easy and polished as people have come to expect from other fintechs, but with a global reach, whereas fintechs tend to be very highly regional,
Mm,
with a global reach and much higher margin, much lower cost structure, fundamentally. The business that we've been using as a sort of point of comparison lately is Chime. Chime, I don't know how they're trading these days, but they IPO'd at I think about a $20 billion valuation.
yeah.
If you look at all the kind of parameters of that business, their ARPU is around $200, whereas ours is about $1,000. Their deposit base is quite small relative to their transaction volume. Their deposit base is not even substantially higher than ours, for example,
Mm,
at obviously much higher transaction volumes. Their growth rate, I mean, they're larger scale, but the growth rate is a lot slower, and they never made a profit, whereas we've been profitable since day one.
yeah.
I think that's the basis of comparison, because you look at it and say, look, is DeFi going to re-platform TradFi? And the answer to that, I believe, is yes, because it's structurally lower cost and much more efficient.
Yeah.
And so if we can scale this business to the scale of, let's say, a Chime or a Revolut or a Nubank, but generate way more revenue and much higher margins, I think that's the signal that will lead to kind of a bit of a watershed moment where there's like a big replatforming that takes place.
Mm. Um, I think that's quite exciting. I think of all the features and potential new products that you talked about, like, I think if there are three kind of revenue sources that you generate today, of the things that you mentioned or the things you haven't mentioned, is there anything else that you think down the road could be a big revenue or profit driver?
I think swaps and perps, I think is
Yeah.
going to be pretty big.
You're going to build it yourself, or you're going to integrate with like Hyperliquid or something?
We're going to integrate with Hyperliquid. Yeah, we're not going to build our own perps exchange.
like actually Hyperliquid, or just like
Yeah,
a Hyperliquid?
yeah.
Oh, okay.
No, yeah, Hyperliquid. I mean, it just makes sense. I mean, Hyperliquid has a great affiliate program
Yeah,
where I think
they
it's
do.
like 30% of all fees go
That's right.
back to like the referrer. I mean, that's great margin. We're not going to
That's
build our
great
own
margin.
perps exchange. So integrating that, there's also a scaling factor where if you do a lot of volume, your fees, your taker fees are lower on Hyperliquid. So if we can aggregate that and provide that to our users, then actually it becomes more efficient for people to trade on EtherFi. So I think perps and swaps is going to be a big revenue driver. I mean, if you look at, for example, Revolut, huge percentage of the revenue is actually driven by crypto now. And if you try to use the crypto product of Revolut, I mean, it's like horrific. I mean, it's kind of a joke. So there's I think there's a lot of room to play there.
And that'll be done, I'm guessing, through the EtherFi app. It'll be like a mobile
Yeah,
first. Okay.
yeah. If you do, you can already download the EtherFi iOS app, and it's obviously like all this functionality is going to be turned on there.
How soon would the swap function come live, you think? Whether it's Hyperliquid or not? Yeah. You can already
Um,
swap. Yeah.
Couple months, yeah, like
Oh,
a month or
wow.
two.
Okay. Oh, wow.
Oh yeah, it's very we're the fiat on and off ramp is coming next week. We already have it in internal beta. So that lets you wire money in and out of the account. You wire fiat into the account, converts to stables, and then you could buy
Oh, wow.
BTC, buy ETH, deploy into DeFi. So that's coming imminently. Um, we've got a bunch of stuff in the works for the Hyperliquid and swaps integration. So that's like a couple months conservatively.
Yeah, very cool. That's
I mean,
very
that's the
helpful.
thing that, as I said, that could blow out the projections on the upside substantially. It's if you think about like just a really nice app that you can like register all your wallets and your exchange accounts and obviously all the stuff that's in the EtherFi vault, and it's just a really nice portfolio tracking experience. It becomes a bit of like a destination for you, where it's just that you just go there to check on your stuff, and then you just turn on swaps and perps with the value of your entire portfolio serving as collateral. Like that's a really sweet product. Like I think
Mm,
that's going to onboard a lot of users.
I could see
Plus,
that.
I guess we're doing so many things. I completely forgot. We also just recently rolled out travel rewards integration. So you can book your hotels on through EtherFi and get
Mm.
5% cash back.
Who's
And
paying for
that's
that? Squirrel?
no. So the nice thing about travel rewards is that the margins are really fat.
Mm.
So we get, I think, a 10% margin on all the bookings just by directing it through the product. So we make 7% margin on that. So it's a huge revenue driver. As that scales, like I mean, that's an enormous margin on hotel bookings. Um, and anyway, so that's an
Yeah.
example of something and we're going to obviously roll out flights. Right now it's just hotels, but we're going to add
Yeah.
flights there shortly. So it becomes very much like an Amex or any card type product where you can like do bookings, and that's a very large revenue driver for for Amex or the Chase, Sapphire, Visa, or
Yeah.
other like premium cards.
Um, so off the 80 to 100, maybe higher if swaps come live, like of the ARR, do you have an equity entity? How much of that goes to the token holders? How does that all work?
So our focus is 100% alignment around the token. So I mean, we're one of the few projects that has direct revenue accrual, so weekly token buybacks. And as the profits scale, we plan to continue increasing that. Um, so anyway, so all the alignment is around the token. We don't plan to, like what some projects do is it's like they have the protocol and then the
Yeah.
labs company then starts building a whole bunch of other products that drive revenue to the labs equity holders off of the protocol that doesn't then accrue to the token. So we don't plan to do any of that. This is why like all the travel stuff, the card business, all of that is part of the entire revenue stream that then accrues back to token holders.
Yeah. And is that token burned or is it distributed to like staking and whatnot?
Currently, it's distributed to stakers. We're gonna. There's basically three things you can do. Well, no, there's more than three things.
There's more. Yeah.
Broadly speaking, we think of three categories. There's buy and burn. There's buy and LP, which is you buy the token and then use it to LP to provide deeper liquidity on chain. And then there's buy and emit to stakers. In the past, we've done buy and LP, and we beefed up the liquidity on chain. And then we switched to buy and emit to stakers. And over time, we'll probably sort of multiplex across the latter two, where we'll buy an LP some and buy and emit to stakers. I don't think currently our staking rate is too high. It's 25% APR, like it doesn't need to be that high. That's like unnecessarily high. So we're probably gonna like shift that to do more buy and LP to help create deeper liquidity on
Got
chain.
it. Understood. And how much of your ARR do you plan to allocate to these kind of activities?
The way we think about it is it'll be a percentage of profits, because we don't want we don't want to have like the bankrupt the entity that's doing the work in order to just funnel it. That doesn't make sense long term. So think of it as a share of profits. So as the business scales and the profit margins increase, which naturally kind of happens, we plan to increase the buybacks. Currently, it ends up being around 15% of revenue goes to token buybacks.
Makes sense. Got it. How are we doing on time? You got to go?
I do have to go, yeah.
Okay.
But we can wrap up.
Yeah, Mike, thank you so much for your time. Really appreciate it.
Yeah, no, it was great to be here. Great questions. Definitely asking the right things. I hope more people start asking these types of questions rather than just more superficial kind of stuff.
Yeah, the bidders like to know, but thank you. Have a good one.
Yeah, cool.